This chart is a great example of why traders enter a position and how multiple factors combine to create a high-probability setup. The first thing to notice is that the overall market is in a strong uptrend, which means price is consistently forming higher highs and higher lows. Trading with the trend always gives a trader a better chance of success compared to going against it. A rising trend line has been drawn, connecting the important swing lows, and this line acts as a dynamic support where price repeatedly bounces back up. Alongside the trend line, we also see horizontal support zones where price previously paused or reversed, and when the market retests these zones after breaking out, they provide excellent entry points. The real strength comes when both the trend line and a horizontal support zone overlap at the same price area, creating what is known as confluence, which increases the reliability of the entry since multiple technical factors are aligning. To make these areas even stronger, we see massive bullish candles forming right at or after the retests, which shows clear dominance of buyers and confirms that the uptrend is likely to continue. By combining trend direction, trend line support, horizontal levels, confluence, and strong bullish candles, traders can filter out low-quality setups and focus only on high-probability entries. This approach reduces emotional trading and provides structure to decision-making, allowing traders to enter confidently with a plan for both their stop-loss and take profit. This chart is a clear demonstration of how multiple confirmations align to signal a strong reversal. At first, the market is moving upward, supported by a rising trend line. However, once price reaches a key resistance level, we see what's called a buyer's trap. This happens when price briefly breaks above resistance, luring traders into buying, only to immediately reverse downward. That false breakout is the first warning sign. Shortly after, the trend line itself breaks down, which is the second major signal that bullish momentum is weakening and sellers are taking control. The chart also shows a neckline forming, which acts as a horizontal support level where price has bounced multiple times before. Once the neckline is broken, that confirms the structure has shifted from bullish to bearish. This neckline breakdown acts as the final confirmation that the market is entering a downtrend. Traders who waited for this multiple layer of confirmations, buyer's trap, trend line breakdown, and neckline breakdown, had a much higher probability of entering a successful short trade. This image emphasizes the importance of not relying on a single signal, but instead waiting for confluence. When multiple factors line up, false breakout, trendline failure, and key support break, they provide a powerful confirmation that a reversal is real, giving traders confidence to act decisively. This chart is a perfect illustration of a bearish trading setup where multiple signals align to confirm a strong downtrend continuation. The market initially makes a significant high, but instead of creating higher highs, it starts forming a series of lower highs, LH, which is an early sign of weakening bullish momentum and growing bearish pressure. Each lower high shows that buyers are unable to push the price back up to previous levels, and sellers are gradually taking control. The setup becomes clearer when price breaks through the support zone, highlighted in green. Support zones are areas where price has historically bounced upward, but once they are broken, they often flip into resistance. This breakdown is a strong signal that bears are in control. To make the setup even stronger, the market doesn't immediately crash, but instead pulls back to retest the broken support level. On this retest, we see a double top formation on the lower time frame, which confirms rejection at that level. This retest acts as a textbook confirmation that the old support has now turned into resistance, and price is ready for a deeper drop. The chart also includes a downward sloping trend line, which perfectly aligns with the series of lower highs. When price retests this trend line after breaking the support zone, it gets rejected again, reinforcing the bearish setup. The confluence of the trendline resistance, the double top pattern, and the retest of broken support provides traders with a high probability short entry. After this point, the market sells off strongly, validating the setup. The small illustration at the bottom left of the image shows the general idea of the pattern: a descending trend with support breaks, retests, and continuation downward. This kind of structure is one of the most reliable bearish continuation setups because it combines market structure, lower highs, key levels, support turned resistance, and pattern confirmation, double top. This chart is a classic example of how to use multiple confirmations before entering a trade, making the setup more reliable and reducing the chances of falling into traps. At the start, the market is trending upward and eventually breaks above resistance, but instead of continuing higher, it quickly reverses. This move is labeled as a buyer's trap because many traders who bought the breakout are now stuck in losing positions as price falls back below the level. This false breakout is the first warning sign that momentum is shifting. Next, we see the trend line breakdown, which is another confirmation that the uptrend has lost strength. Trend lines act like a dynamic support, and once price decisively closes below them, it often signals that sellers are stepping in with control. After breaking the trend line, price forms a neckline, a horizontal support level that has been tested multiple times. When this neckline eventually breaks, it provides the final and strongest confirmation that the bullish structure is completely invalidated and the market is ready for a bearish move. Key here is that the trade is not based on just one signal but on multiple confirmations: the buyer's trap, the trend line breakdown, and the neckline breakdown. Each of these signals adds weight to the decision, filtering out noise and low probability setups. After all three confirmations align, the bearish move accelerates, and traders who waited for these signals could enter confidently and aim for the marked target zone. This shows the power of patience and waiting for confluence, rather than rushing into trades based on a single indicator or pattern. This chart represents a classic example of a multiple confirmation trade, where several signals are combined to increase the chances of success. At the start, we can see that the market was moving in a clear downtrend, confined within a descending channel, consistently making lower highs and lower lows. Eventually, the price approached a strong horizontal support zone at the bottom, marked by the gray line, where buyers had previously stepped in. At this zone, the price formed a double bottom pattern, which is a powerful bullish reversal signal. This pattern indicates that sellers tried twice to push the market lower, but buyers defended the level successfully, preventing further decline. After the second bottom, the market showed strong bullish strength through a big bullish candle, often referred to as the confirmation candle. This candle is a sign that momentum has shifted from sellers to buyers. Following this, the price decisively broke out of the descending channel, further validating the change in trend. These signals combined, the support zone, the double bottom formation, the bullish confirmation candle, and the breakout, provided multiple confirmations for a buy entry. In terms of trade setup, the entry point would be just after the breakout and bullish confirmation candle. A stop loss would be safely placed below the support zone, protecting against false breakouts, while the take profit would be set near the next resistance level, marked by the upper gray line. As shown, the trade played out successfully with the price reaching the target zone, delivering a strong reward compared to the risk. This setup is called a multiple confirmation trade because instead of relying on one single signal, the trader waits for several confirmations, making the trade more reliable and effective. This chart explains the concept of waiting for confirmation after a breakout, which is a very important trading rule to avoid false signals. On the left side of the chart, the price breaks above a resistance level, but the note clearly says, "Don't enter immediately after a breakout." This is because many times the market creates a false breakout, price shoots above the level, traps traders into entering early, and then quickly reverses back down, hitting their stop loss. The shaded red zone shows how traders who entered too early would have lost money. On the right side, the chart shows the correct approach. After the breakout, the market did not continue straight up. Instead, it came back down to retest the broken level. This is called a correction or retest. During this phase, the previous resistance turned into a new support zone. When price respected this zone and then formed a bullish breakout again, it confirmed that the breakout was real. This is the ideal entry point. Traders entering here have a much safer position with less risk and a higher probability of success.